Hey everyone, welcome back to the channel. If you're new here, my name is Tim, and today we're going to go into my favorite strategy when it comes to options, and it's very popular among other options traders too, and that is the wheel strategy. Whether you're just getting started with options or you're looking for a simple yet effective strategy to make consistent income, the wheel is a great place to begin. Stick around as we break it all down step by step and get you ready to start making smarter trades and consistent income and grow your accounts. So the wheel strategy is a method that involves selling options to generate income. It's called the wheel because it follows a circular process of three main steps. Here's how it works. So the first step in the wheel is selling a cash secured put. This means you're selling a put option on a stock you like or would be willing to own. You choose the strike price, which is also the stock price that you would be willing to buy the stock at, and you sell the put option to someone else, the buyer of the option. In exchange, you collect a premium, which is the price someone else is willing to pay for that option. For example, if you were looking at AMD as an option for the wheel for you, on the expiring this Friday, if you were to sell a 98 strike price put option, that means you'd be willing to buy 100 shares of AMD at $98, and you would be paid $152 for that options contract. I know it says $1.52 here, but a contract is 100 shares, so you multiply this by 100, so you get $152. But the key word here is cash secured. You need to have enough cash in your account to buy the stock if the price goes below your strike price. In other words, you're saying, I'll buy this stock if the price drops below this point. In this example, you would have to have enough money in your account to buy 100 shares of AMD at $98 per share, so you would need $9,800 as cash for the collateral. Step 2. Now, if the stock price falls below your strike price, the buyer of your put option will likely exercise their option. It's not always a guarantee, but they are likely to exercise their option, and you will be assigned the stock. By assign the stock, that means you are buying the stock. So you have to buy the stock at the strike price, but remember you already collected the premium up front, so your effective purchase price is actually a bit lower. So your cost basis, or the total amount that you technically paid for the shares, would be the $98 minus the $1.52 per share that you received for the contract, bringing your cost basis to $96.48 per share. Now, if you end up owning the stock, that's okay. The goal here is to own the stock that you like at a discounted price. Once you own the stock, the next step is to sell a covered call. A covered call is when you sell a call option on the stock you just bought. You're essentially saying, I'll sell you my stock at this price if it goes above this level by this date or the expiration date. Again, using AMD as an example for this upcoming Friday. So for an example using AMD, let's say I had purchased 100 shares at $100, and weeks previously I wanted to sell a covered call. I could do it either at my cost basis of $100 per share, or I could even go to a little bit higher, like 101, so I get more profit if the stock price rises above that. But we'll use 101 as an example just to make it easy. So in this case, I would be paid $217 to sell a call option, where I'm saying I'd be willing to sell my shares for $101 per share if the stock price goes above 101 by the stock market close on expiration date. Now, the last step is to get those shares called away and repeat the process. So once your shares, after you sell a covered call, get sold, you start the whole process again by selling a cash secure put, either on this same stock, or you can choose a different stock, whichever one you choose. As a tip for any beginners, I suggest looking for dividend paying stocks that have weekly options preferable. Just that way you can have weekly income. And if for some reason you aren't able to sell covered calls after you get assigned, say because the stock price drops significantly, then you can simply wait and you will still collect dividends every month or every quarter, depending on the stock's dividend schedule. So now let's talk about the advantages of doing a wheel strategy. So why would you want to use the wheel strategy? Well, there are a few key advantages. You're generating consistent income. By selling options, you're collecting premiums regularly for both selling puts and selling covered calls, which can provide a steady income stream. It is lower risk than other strategies, since you're either selling cash secure puts on stocks you'd want to own or selling covered calls on stocks you already own. The strategy is far less risky compared to buying calls. You have increased flexibility. You have multiple ways to win. You can keep the premium from the options you sell, and you can either not buy or have to sell your shares, or you can get the premium and you still get to own a stock at a discount and potentially make a profit on a covered call if you sell above your cost basis. So you can make money in all four steps of the wheel strategy. And the last advantage is it's ideal for range bound stocks. It works on stocks that are relatively stable. You're betting that they won't experience a big price swing. If you can pick the right stocks, it becomes a consistent income generator. Now, there are some risks to selling the wheel strategy, but it's not as big a risk as a lot of people on the internet will tell you. One risk is being assigned the stock and then having the stock drop significantly. And that can be mitigated in several ways. I've had that happen to me on one of my wheel strategies with Kohl's. Basically, it just fell significantly. I had originally sold a put at $19.50 and now it's at 12 something, which means right now I can't sell covered calls. But what I do is not only will I collect dividends because it is a dividend paying stock, but I've actually sold 2 more puts. And I know what you're thinking, that sounds counterintuitive. Why would I sell puts on a stock that's consistently right now dropping in price? And the reason is to lower my cost basis. So I'm collecting premium for selling the option, and also when I get assigned, it's at a lower price than my original, so it lowers my average price of how much I bought the stocks for, which means eventually I will be able to sell covered calls again. As an example, right now I have 500 shares, and right now I did collect $250 on my last call option for 5 contracts. And if they don't get called away come the ex-dividend date, I will collect $250 in dividends also this quarter. Another risk is missing out on big gains if the stock price has a big shoot up. So if you're selling a covered call and it typically is fairly stable, but then all of a sudden some great news happens or a new law changes or something else causes the stock to have a meteoric rise, then you are under contract to sell your shares at the strike price you chose. So it could go 10, 20, 30 or more dollars higher if that were to happen, and you wouldn't be able to realize any of those profits. And the last one, which sometimes holds people back, is this old saying that it takes money to make money. In this case, it is very true. You have to have the cash in order to do the cash secured put in your account in order to start the wheel. You can't start at $100 or $200. You have to have a significant amount, several $1,000s sometimes, before you can start trading the wheel. But once you do start collecting the wheel, you can start generating that consistent income. So to wrap things up, the wheel strategy is a great way to generate passive income by selling options, especially for beginners. It's a relatively low risk strategy, and as long as you pick the right stocks, remember it is not a get rich quick scheme, and it requires some patience and practice. That's why in all my videos I say before you do any of these option strategies, do paper trading. Just that way you can get used to how your interface looks or how the options chain looks. But if you're consistent with the wheel, it can definitely work in your favor. Alright, that's it for today. I hope this video helped you understand the basics of the wheel strategy. If you found this helpful, make sure you hit that like button, subscribe for more trading tips, and leave me a comment if you have any questions or want to share your experience with the wheel strategy. Thanks for watching, and as always, happy trading.